David, welcome to Questioning the Manager. So let's start by asking, what does an ideal investment look like to you?
Well, I think you've got to go back to the fundamentals of a business, and we're trying to find those companies that are good quality. And what I mean by that is, how are the company positioned versus some competitors? We like the global market leaders out there. Do they have strong brands, which means, do they have pricing power in that market? You've got to look at the competitive threats. Do they have high barriers to entry? And then look at, you've got to analyse the management team. Do they have a good management team that can deliver on the strategy they've laid forward? Underlying that is also the financials of a business. Does a company have a strong balance sheet? Does a company have a good cash flow? And I think you've got to focus on those two, because fundamentally that will mean so much more in terms of the dividend payment that the company can afford, really, because that's the key element for us as income fund managers, making sure that a company pays its dividend and actually can sustain it and maybe grow it into the medium to longer term.
Let's look towards some of the companies in the UK market. What's your outlook for earnings growth?
Yeah, well, I think earnings growth is likely to be quite difficult, really. I mean, you're seeing slowing economic growth in China, in emerging markets. You're also seeing the lower oil prices impacting sort of capital investment in certainly what is a very big industry, and that's going to obviously impact not just the oil majors but also some of the industrials that supply products to that industry. So with that in mind, I think aggregate earnings growth in the UK market is likely to be quite subdued going forward. Having said that, there are probably going to be pockets of growth. So underlying there are other sectors. I think consumer sectors is probably going to grow markets. So I think aggregate earnings probably quite dull. And probably not much growth there, but actually if you exclude those oil and gas large industries, actually elsewhere there's probably still going to be some earnings growth. I just don't think it's going to be as large as we've seen in the recent past.
Okay, given that scenario, where are you finding opportunities?
Well, the three examples of opportunities I like to give are the consumer. I think the consumer is quite in a healthy position at the moment, given wage growth, inflation, given lower energy bills coming through. And one of the stocks we own that plays into that is Greene King, the pub operator. And what I like about the company is not just it should be a beneficiary of that consumer environment. It's also made a recent acquisition, a Spirit Pub company. And I think the benefits of that acquisition should come through into driving earnings growth over the next couple of years. So again, one, we're not necessarily relying on the economic outlook to drive earnings growth, but something that can drive earnings growth despite that through this recent acquisition. I think the second opportunity is finding those companies with structural growth. And I think one of those companies we own at the moment is AstraZeneca, the pharmaceutical company. Pharmaceutical companies have been in the doldrums over the last decade, really, and now we're starting to see a bit of a turnaround in terms of the investment they put in research and development to produce drugs that can come to the market over the next few years, really. And one specific area that Astra is focused on is immunotherapy, which is cancer treatment. Instead of using chemotherapy, it's to give a patient a drug that can use its own body to fight such a devastating disease, really. So we should see that come through in the next few years as those drugs get released to the market and should afford good pricing. And finally, the third one I think is finding those companies that are investing for growth. One company that we own that we like, we've held it for quite some time now, is Hilton Food Groups, which is a food packaging company. And it's, despite being what can be described as maybe an unsexy business, packaging meat, it's got an incredibly good business model. It's got very high returns on invested capital, and it's won recent contracts with both Tesco's in the UK and Woolworths in Australia. And now that investment is starting to come through in terms of those businesses coming through, actually you're starting to see profit growth come through a lot more aggressively than in the recent past. So it's a company that we like, high returns, good business model, and now we're seeing earnings growth come through given those new contracts the business has won.
David Smith, thank you.
Thank you very much.